FOMC pauses, at least for now. Here's what you need to know before the bell. So yesterday, the Federal Reserve paused their rate hiking campaign, but did hint potentially at 1 to 2 more rate hikes this year. The question, of course, whether or not they'll actually hike rates is an entirely different discussion. But overall, what the markets took away from it is that initially the market sold off yesterday on the news of potentially 2 more rate hikes. But given that Jerome Powell did not commit to a rate hike in July, markets rallied back to about break even yesterday, actually finishing up a little bit from where they opened. But again, as we've talked about over the last few days, markets are very deviated now from the 200-day moving average. There's a very large gap here between where prices in the S&P are and where the 200-day moving average is. Now, we're going to get a correction here. Likely may even start to see a little bit of corrective action today. We'll see how the market hangs out. The first level of correction is going to be back towards this 20-day moving average, which is along where these tops were when we broke out earlier in June. Now, there's been a very big advance here over the last 2 weeks since that breakout. And of course, we've been in this consolidation range for about 45 days. So that gives a pretty good level of support at that point. So a pullback to that 20-day moving average, currently around 42.30 on the S&P, is a good first target. Second target, of course, is going to be the 50-day moving average at 41.16, and that really pulls us back into this consolidation range that we saw. And then below that is the 100-day moving average. I wouldn't really expect much of a decline below 4,000 at this point, or a full retest of the 200-day moving average, which, if we go back to that, it's going to be around 39.70 at the moment. On the S&P, but that big of a correction, we're going to have something really kind of going on, maybe economically at that point, maybe a very sharp jump in unemployment, something like that to really trigger that kind of a sell-off. But we're not there just yet. So again, corrections probably back towards the 50-day moving average is going to be your opportunity to increase exposure into portfolios. Now, some of the areas of the market have really gotten ahead of themselves. Technology is a good example. Discretionary communications, that's where you should expect the correction. During that corrective process, however this occurs, we'll likely see some money flows into areas of the market that have really been out of favor as of late. Staples, utilities, real estate might see a little bit of pickup of those money flows, at least in the near term. So again, though, markets here very extended. So, getting a bit of a pullback here would actually be healthy for the market and allow for another advance in the market later this year. Now, will that happen today? Probably not. But sometime this summer, I would certainly expect either a consolidation that allows these moving averages to catch up to the market, much like we saw back during the April, May, June period. We saw that long 45-day correction allowed moving averages to kind of move up to the market. So we'll either see that kind of consolidation, also allowing you an entry point, or some type of corrective action back to a level that will give you a better entry point. But be a little careful chasing markets right now. They are a bit extended. We are a bit ahead of ourselves. So again, keep some cash dry. Look for an opportunity that has a better risk reward to it. I'm your host, Lance Roberts, and that's what you need to know before the bell.